Hello everyone, welcome back to my channel FRM Unplugged. As mentioned during my last video, I am back with the third in the case study series of FRM, and today we will be discussing about Orange County. It was a county in the US, and it had invested a substantial sum of its money in some investment scheme, and eventually the investment ran into losses, and it was a huge loss of around 1.4 to 1.5 billion dollars. So it happened in the mid 90s, so it's almost 3 decades since it happened. So if we look at the basic fact sheet of this case, right? So it's Orange County is a county in the Los Angeles metropolitan area in Southern California, and like in US, most of the counties have certain level of autonomy to invest, to have their own investment policy and strategy, chart out their own ways to increase the returns on the funds that they have, and they were pretty. I mean, they were enjoying pretty autonomy in deciding what to invest, where to invest, and all that. So the county was the financial investment was handled by a gentleman by the name Mr. Citroen. He was the treasurer also of Orange County, and he was supposedly a financial wizard, an investment wizard, and initially few years he was able to generate returns which were substantially more than the returns of the other counties in US. So he was like a blue-eyed boy of the mutual fund houses, of the other investment houses, and things were going pretty smooth till in late 1994, when the interest rates increased. Their portfolio ran into losses and around 1.4 billion dollars. So eventually they had to declare themselves bankruptcy under chapter 9, and subsequently obviously they recovered their losses through various lawsuits. They sued their investment partners like Merrill Lynch, but in the first place they ran into rough weather and they incurred huge losses. How they incurred? Well, the basic idea of duration is it is a measure of maturity, right? So a 5 year bond, let's say a bond whose maturity is 5 years and which pays back the coupon every year. So that the duration of that would be around, let's say, 4.1, 4.2 years, which means the it takes 4.2 years for the bond issuer to recover the money that it has lent. So if we look at the maturity and duration mapping, see, the higher we go for the maturity, the less is the duration. So if we look at 5 years, the duration is for a 5 year maturity, the duration is 4 years. But for a 30-year maturity, the duration is 11.26 years. So the way to interpret this is, if I am a bank and I have issued a 30-year loan, then I am able to recover my entire money in 11 years, because you would know that initially the interest component is very high and the principal component is lesser. And for the bond, from the bond perspective, if a person is subscribing to a 30-year bond, then it is able to take back its amount that it has invested in 11.26 years. Another important concept that we will be using here is the concept of yield curve. Yield curve is just nothing but the time, it just shows the relationship between the yield of a bond or a government security and the time period. It's basically the term structure of the interest rate. That's the term that you use in the financial world. So if you see here, basically yield is calculated for all the government bonds, right, at each term to maturity remaining. So like that, for every maturity period, it is plotted against the time period. So for, let's say, if a bond is remaining terms to maturity is 6 months, 1 year, 2 year, and the corresponding rates, if you plot it in a graph, we will get the yield curve. So this yield curve is it helps the investment managers to plan their investment agenda. They can use the shape of the yield curve in determining whether, so just an example for an yield curve would be, if the yield curve is upward sloping, right? So then the short term maturity of the interest rates on 1 year or 2 year will be less than the interest rate on 5 years. So people or investment managers would be encouraged to borrow at the short term, let's say 1 year, where the interest rates are low, and lend for the longer duration where the interest rates are high. And the yield curve shapes are determined by the level and the slope. The level of the curve actually indicates the general level of interest rate in the economy. For example, in Indian context, it's the it's the repo rate, the rate at which the Reserve Bank lends money to the bank. So that is the anchor rate for these yield curves. And then there is the slope. The slope is the difference between yields on short-term bonds and long-term bonds. And these are the basically three shapes. The normal one is the upward sloping yield curve. The inverted one, not very common. It is basically, what should I say, associated with maybe a precursor to a contraction or a precursor to a recession, where actually people have a view that interest rate in future is going to decline. So then it's the inverted yield curve. And the other one is the flat, which means whether it's for 2 months or 2 years, it's the yield is the same. So it goes without saying that the normal yield curve, which is the upward sloping yield curve, is the most common. So notes is one category of instrument that Orange County heavily invested in. Notes is just a fancy term for a bond. In fact, it is not a bond, it's something related to bond. So it's a derivative whose underlying is the bond. So there are many types of notes, but of interest here is the inverse floater, floating rate, index amortizing notes, and dual index notes. So the most dangerous note, dangerous as in the note which can do the maximum damage, is the inverse floater note, that we will see when we come to the analysis of their investment. So inverse floater note, the term inverse gives away what it is about, right? So it's basically, if my, let's say, LIBOR or MIFOR or whatever is the reference rate, if it increases, then my returns here will be lesser and vice versa. Then we have the floating rate notes. It's basically, it's just the opposite, means it's directly related to the market reference rates. Then there is the index amortizing notes, which is basically the debt payment time frame, so to speak. It depends on the market interest rates like LIBOR. So even as rates increase, we will see that the maturities increase and vice versa. So it's very, I mean, if interest rates rise, my maturity will rise. If interest rate falls, my maturity, which is the time period, will fall. Why this was more common is because this was here, since it is directly related to the market reference rate, its volatility of this maturity was somewhat lesser than collateralized mortgage obligations, CMO, what you call. CMO are basically, the mortgages which the US banks generate, and then they securitize it, and they sell it to the investors. And each one of those tranches, they are like called collateral mortgage or obligations. And the last one is the dual index notes. It's basically linked to the difference between the active and the market indices. Then we also have something called a repo and reverse repo. So we will say that these guys, Orange County guys, they had taken help of this mechanism. So repo is basically a mechanism. Think of it this way: repo is repurchase agreement. The most simple example of a repo would be the central bank, right? Central bank monitors the other banks in an economy, right? So if bank A wants to get some money, what that bank will do is the bank anyways invests in government securities, treasury bonds and all, right? So these are 100% credit guaranteed instrument, and they will give this. Let's say they want to raise $100, so they will give about $100 worth of security to RBI, and they will take $100 from RBI. And when they are executing this transaction, then this bank A will enter into a contract with Reserve Bank saying that today I am taking $100 from you. After 6 months or 1 year, whatever, I mean, this repo are not for 8-10 years, they are usually for 1, 2, 3 years. It can be around month, 2 months, so like that. So it will also, that agreement will have that after 1 year, I will repurchase that bonds in, let's say, 103 rupees. So today I have given the bond to RBI, I have taken $100. So logically I should give back $100 only, but that's not the case. The bank A will give back $103, and it will take back the bond. And the difference between this 103 and $103 is basically what you can call the interest. So from the Reserve Bank, from the central bank's point of view, this is supposed to be a repo transaction. Here, who is the security seller? The security seller is Bank A. So Bank A, so repo is like a forward contract where Bank A knows that at the end of 1 year, I will have to pay this much, let's say 103, which means this person is essentially long. He has purchased money, so to speak, by giving the interest. And when you look at the same transaction from the other way around, it becomes a reverse repo. So reverse repo is just like today. So in case of Orange County, how it happened was, let's say all the investors had paid, just for example, $100 to Orange County, and Orange County has the flexibility to invest it. So Orange County will use this $100 and it will buy a bond. So it will get into a normal transaction where it will take, let's say, $100 bond. Now, what this Orange County can also do is it will get into a reverse repo transaction. How it gets into a reverse repo transaction? So it has the bond with it, right? And it doesn't have $100 because it has already paid $100. Now this is a security which is lying with them, right? It is earning interest, obviously, at the end of whatever, every 1 year it will get some coupon payments from the bond. But if this person, treasurer of Orange County, wants to increase the return, what he will do? He will give this security to another security dealer. It could be anybody, it could be Merrill Lynch, it could be some other fund houses, and it will take another $100, so to speak. So it had bought this $100 bond in a repo transaction, and the same bond it is giving to another person to raise again $100. This is a reverse repo transaction from Orange County's point of view. So in our first example, if you see, Bank A was giving its bond to central bank, right? And from central bank's perspective, it was a repo transaction. From Bank A's perspective, it was a reverse repo transaction. Now here, when we are coming to Orange County is giving the, first it is giving money and taking the bond, and then it is giving the bond and getting money. And again, it is what it's using with the doing with that money. He is again buying a bond, and then what again he is doing with the bond? He is again giving this bond to another person, like let's say Merrill Lynch, and again raising some additional funds. Why he was doing that? Why Orange County was doing that? We will come to it. Now, if we see, this is Orange County's investment portfolio. Coming to, just see at the right hand side, the equity. So this guy's Orange County total equity, total liability was, let's say 20538, out of which 7550 was its equity, and almost two times of it, it had the loans, which was like which was reverse repo transactions. So it was a highly leveraged investment that these guys were doing. See, 7,000 is its own money, and through the process that I just explained, by buying the bond and then again giving the bond and raising money, and again buying another bond and then again giving that bond and raising money, that way he had raised another two times of their capital. And what they had done with this money, let's come to the left hand side, right? So inverse floating notes, the first one that we discussed in notes, that is supposed to be the biggest troublemaker. So there these guys had around 26%, and other fixed income securities were 57%. Those are pretty benign, so we will not talk about that. And then there are the other three types of structured notes, like dual index, floating rate, and index amortizing notes. So when you have, like I mentioned, when you have an upward sloping yield curve, the natural thing to do is to increase the, you borrow money in short term and you lend money in the for the longer term. Now let's see how these guys achieved it. So if we look at a normal transaction first, let's say it buys $100 million 5-year bond in a repo transaction, right, at 3.5% coupon. So, and this guy sells the bond bought to Merrill Lynch and just see, this was a 5-year bond at 3.5%, right? 3.5% was the coupon. Now, what these guys are doing? These guys are giving this bond to Merrill Lynch with the promise that I will buy it back after 1 year at 3%. So essentially, this guy is trying to take advantage of the 5-year interest rate, which is 3.5%, and he is giving, let's say, 3%, which is 1-year interest rate. Remember the upward sloping yield curve? So he was making a cool 0.5% margin from here. So apart from this arbitrage, anyways, he was getting 3.5% from the bond. So every year the payment, assume that it's a annual coupon paying bond. So he was getting 3.5%, and additional 0.5%, like I just mentioned, was the additional amount it was getting out of lending money through reverse repo. Orange County didn't stop in one cycle. It continued it two times, which means, so first he bought a bond and then he did a reverse repo and got money. Again he bought a bond, then gave his bond and got money. So two cycle, then again he used that money to buy a bond. So in the end, he has three bonds which he has bought and two reverse repo transactions where he has promised to buy it back, right? So two times he has, means out of the three times that the Orange County bought the fund, the first time was with his own money. The second and the third time was with borrowed money through reverse. 5-year maturity will have a 4-year duration. So in this case, if we see, every price change for the bond is equal to minus of the duration into yield change by $300 million into divided by 1 plus the yield. That's the formula, right? Now, with a 3:1 leverage, right? So 3 times, so we will multiply this formula by 3 and effectively it becomes around 12. So here, what does this denote? That with a 3:1 leverage, what is my formula coming to? Minus 12 into yield change by 100 million by 1 plus y. So this effectively means, if we again go back to our mapping slide, we will see that a bond with 30-year maturity will have a 12-year duration. So why they were increasing the duration? Because it wanted to take benefit of the higher rates for the longer term maturities. That is one. Secondly, these guys expected rates to fall. So when duration is large, even a small fall in interest rates will appreciate the value of the bond quite substantially, and there will be huge profit to the customer. If we look here, this will be the profit to the customer. So imagine out of his own funds, $100 million, he is getting 3.5 million yearly. Let's take for a year. So he's getting 3.5 and he has borrowed $200 million. So on that, his net income is 1 million. So total he is getting 4.5 million, right? Now, this is just the earning from his bond. Now, we will also have to see what is the return. Return as in what is the change in the price of the bond. So, if, just for example, if the rates fall from 3.5 to 2%, if we use our formula, then 7.07 million is the increase in the value of the bond. So, that is for one tranche of 100 million. So there was one tranche of 100 million through his own funds, and there were two tranches of 100 million through his borrowed fund. So sum total would be 7.07 plus, so 7.07 is the return from his own equity, and 2 times of it, 14.04, is the return from the bonds which were purchased by the borrowed funds. So total is around 25.71. So close to 25% return was getting generated. Means had the rates declined. So these guys were, obviously, when you are trying to increase the duration of the portfolio, this essentially means you are betting on falling interest rate. Otherwise, if you are increasing the duration, it is very susceptible to losses if rates increase. So ideally, increasing duration is not advisable until and unless you are reasonably sure or you have cues that okay, rates are going to fall. This was for interest rate decrease from 3.5 to 2%. But there is an other side to it, right? The rates could have increased also. Now let us see what would have happened if rates would have increased. So if rate would have increased, this catastrophe was awaiting them. So since bonds, right, whatever is the contracted coupon, I will be getting it regardless of the rates fall or increase or whatever, because that's committed to me, right? So my 4.5 million income from the bonds, that remains intact. It was there without at the time for the scenario where rates had fallen, and now this is the same when rates are increasing. Now here we will see how the price of the bond would have been impacted. So when the bond price changes from 3.5% to 7%, then going by the formula, we will have 14.14 million value will be lost in the $100 million tranche. And similarly, like we did for the last one, there is a $200 million that these guys had purchased bonds by borrowing through reverse repo. And what is the loss in that? Two times, right? So 14.35 was for 100, and again 28.70 was for 200. Here the duration was much more than the maturity for bonds, and that's how these losses had come in. So, and there was no why. So the investors, the people who had invested in the Orange County, they never had any inkling of this rate increase scenario also. All they knew was Orange County was investing in government bonds. But these government bonds, yes, they were government bonds, but they were also investing in some derivatives of these government bonds. For example, inverse floater notes. In inverse floater notes, there was like when rates will decrease, then their rates increases, and vice versa. So when the market reference rate is increasing, then there was an additional load up factor, which means, okay, so if 1% is decreasing, then their rates will increase by whatever. But if here the rates were increasing, then the rates would be decreasing by a large amount. There was a loading up factor. So these inverse floater notes were actually doing much of the damage when the rates had increased. So these things were never mentioned in the disclosures, and the investors had invested just going by the fact that these guys were investing in government bonds. So that's how these losses were racked up. It is just so ultimately when the treasurer was asked, like, how come you did? So actually it came out that the treasurer did not understand the actual position he was taking. He didn't calculate the leveraged, the result of the leverage and how it would impact the bond prices. So this is a classic case where people did not understand the position they were taking. It's a plain case of misunderstanding and not knowing where they were investing and subsequently ending up in loss. So that is all about this use case, and thanks for listening. I would urge you to like, share, and subscribe if you found anything of useful. It would mean a lot to me. And I will shortly be back with the fourth in the series of FRM case study. Thank you.